Hello, Tyler Schnelly here. Very important message that I might get upset about. It has to address option sellers. I had a close friend of mine get wiped out, lost millions of dollars basically overnight. Margin call, 7 figures, totally changed his whole life. And I'm upset about what they did because it was avoidable. And that's why if you're going to trade options for someone else or for yourself, you have to understand risk. That's everything. And with what they did, selling, basically they're called strangles. So you're selling naked calls and puts. Sometimes you leg into them and you roll them out. You do all these different things. And their whole strategy, and again, I don't really know them that well. I just know of them through someone else that is investing with them. And I understand the business of options very well. I've been doing it for almost 20 years. I've never been an advocate or a proponent of doing undefined risk strategies. Selling naked calls is very risky. It's not prudent, and it's something that you should stay away from for multiple reasons, which I'll show you here shortly. But I don't know what this guy James Cordier was thinking. His video on YouTube kind of rubbed me the wrong way. I think it could have been done differently. He could have had a lot more in place. And I'm upset about that. I'm upset about it because he ruined people's lives. And if you're going to be investing in the stock market as a fiduciary for yourself, have some risk management parameters. Don't go naked, undefined risk. Yeah, it could work great for years, but then you can get wiped out. So what a better thing to do could be, instead of selling naked strangles, is doing an iron condor. Why not buy some upside protection and hedge your risk so that when something like this happens and natural gas goes up 20% in a day, you don't get wiped out. And now this is a month after this has happened, and of course natural gas has pulled back down 20%. So if he was able to withstand, and if his fund, his hedge fund, his accounts that he was managing was able to withstand the pressure of margin calls, not having the margin requirements to hold these naked call positions, which might have been 6 months out, several months out, they would have been okay. If you had protection and you bought upside calls, then this would never happen. And that's what you need to know if you're going to be investing in the stock market using derivatives. Derivatives are very powerful, but you have to be prepared and you have to have a plan. You have to know how to manage risk. And if you are going to do stuff at a very high level, like level 4 and 5 option trades, like what this gentleman did and ruined people's lives. He didn't have the systems in place, whether it was a broker-dealer situation or him. It's unacceptable. It's not prudent investing. And for me, I'm upset about that because these people's lives are ruined, and they can't get that back. And now, when you think about that, and it's something that you can easily avoid, it's just like, what are you doing, man? Like, why would you even think that's okay? So what if it works great for 5 years? But what happens when these rogue waves, whatever he calls it, which I think is a smoke screen, when that happens, like, it's not okay. It's not acceptable. And moving forward, you need to know what he did so that you could never, ever repeat this tragic mistake. So what I'm going to do is I'm going to move into the next room over here and draw this out on a whiteboard, explain what he did, why he shouldn't have done it, and how this strategy could easily have been mitigated by using protection and modifying the strategy into a defined risk scenario. That's what it's all about. You can go undefined and get wiped out like this guy did and ruined his clients, lost $150 million plus margin calls, full-blown disaster for hundreds of people. Or you can be ahead of the game, being smart and having protection using defined risk trading strategies. That's what I'm all about, and that's what I'm going to talk about and teach you in this upcoming segment here. Okay, before we jump into the demonstration, this is strictly for educational and informational purposes. If you ever were to trade any security or any trading strategy, you should definitely seek suitable and relevant investment advice. And this is example on selling a naked strangle. So this is kind of how it would play out. So this example, you have the natural gas security, starting around here, it kind of does this, and right about this time, again, roughly, you say, I don't think it's going to go above here, which is 4, by this date, which could be several months out, and it could be past this, but that's roughly the scenario. So you sell the call. Again, you're selling the call up here. And you're also, a lot of times, maybe before or at the same time, selling a put. So this is the call side. And then maybe down here you say, you know what, I don't think it's going to go above this level and then this level. So these levels are your strike prices. Now it could be like 1.8, could be like 4.2, but that's roughly the scenario. So you go out, you sell the put down here. So you got the call side, and then you have the put side. 3 to 6 months. Everyone's different. Sometimes, and I'll say for me, and the way that I understand options, and I've been doing this again for almost 20 years, is options decay the fastest within 30 days. So going out longer, 3, 6 months, is not as intuitive because a lot more can happen in a 90-day plus time frame. So you're selling the call there, you're selling the put here, and again, the whole thing is you don't think the market or the underlying is going to be above this strike or below that strike by expiration. So as you're trucking along, come October, whoa, a big spike up. Okay, well, we're getting a little close. Maybe you should do something like hedge and close out the call side, or roll it up, or buy some protection up here. But let's keep going. So then comes this, and then boom, huge spike, biggest spike in 8 years. Who saw it coming? You never know. The markets are unpredictable. There's no guarantee. That's investing 101. Is past performance isn't indicative of future results, meaning anything can happen. There's black swan events. There's things that can happen all the time, and they're going to continue to happen. So this example could have been mitigated. So if you're going to sell a call at a certain strike, and you have all this unlimited risk to the upside, which is very, very foolish. It's not prudent, because a simple way to mitigate this, and we're going to say we don't like this. I don't endorse it. I do not think naked options, especially calls, don't do it. Unless you're a professional market maker or you're working with firms that have systems and a lot of people in place, you can lose your house, you can lose your assets, and that's what happened to these people, and it's not okay. So when you're selling a put, that's technically a defined risk because you can't go below zero. If you're selling 1 point, and this is actually selling cash secured puts is a strategy that Warren Buffett is very much an advocate of. Because if you want to buy a certain stock on or before the expiration date, you can sell the put to get paid a premium to get into that name. And if you have a long-term trajectory and mindset, selling puts to get long securities is not what I'm talking about here. What I'm talking about more so is selling naked calls undefined to the upside to technically go to infinity. And if you have that type of situation, how do you mitigate, and how do you define your risk? You can't define it. So the way around this is selling, which is a much more intuitive strategy than this. And it's something that, in my opinion, if you get it wrong, and you get, a bad trade, which is definitely going to happen. That's part of the game. You can't go in and not think you're going to have losing trades. But you sell the 420 strike and you buy the 450 right there. You have a spread trade to where if it were ever to be, something out of the norm, maybe there's a low chance of probability of it breaking between this spread, which is kind of your zone of where you need to stay below. But all this risk is going to be offset by your long call. And your long call is what defines this into a package trade and cuts that out. Because now you can't lose more than the risk of your spread. And the same to the downside. If you're selling a put here, it's good business to do the opposite and buy the put, so that if you're selling the 180 and you're buying the 150, your risk down here might be 30 cents. And when you start multiplying hundreds of contracts, which is literally what happened in this example, you're able to define, and you can really capitalize your position to where you can't go negative. You're not going to lose all of your investment account and then go into the hole, because that's why we don't like this. Stay away from it. It's not prudent. It's not for 99% of the traders and investors out there. It's something that you definitely need to stay away from. That's really why I'm so passionate about this, is because it was easily avoidable. It was something that a lot of people got affected from, and they didn't understand it. Sometimes you trust people, and you think they have their best interest, and you have a rapport that you build over the years, or maybe things are going great for a couple of years, but this stuff can happen, and you as the person with capital that's investing through someone else or through a fund or through some type of investment product or vehicle, you need to know a basic understanding if it's suitable to you or not at the end of the day, because like I said before, no one is going to watch your money and understand your money and really be able to be the steward of your money better than you. Now, there's a lot of great people out there, but this is the situation where simply turning this into selling an iron condor would have mitigated the risk. So moving forward, what's the takeaway? The takeaway is don't ever sell naked calls, number one. Number two is if you're going to trade options, which again, options is not suitable for a lot of people. You have to understand the risk. You have to be able to know that it's something that is suitable for your investing strategy and your risk tolerance. But know that, exemplify that through your broker, through your advisory person, and know moving forward that if you were to trade this, keep it defined. Know that you have a certain risk tolerance and what is going to work and what's not going to work. So that's all for now. The takeaway is get educated. It starts with education so that you can move forward and reach your financial goals. I'll see you in the next video.